How do you typically decide whether to get a long-term contract or let it ride? Generally, with my options, I try to get a few months out and at minimum, and never more than 5% out of the money per month. You know, so if it's 20% out of the money, then no shorter than 4 months, right? And then at the end of the month, if it's outside of that, let's say I'm down on the option, or I'm the options, whatever, and the strike price is more than 15% out of the money, then it's like, okay, let me cut it and roll it to something else. Or, you know, if it's a volatility play, you could average down or cut or whatever. But if it spikes early, then I leg out of it. I don't always hold anything. Look at Marvel. Marvel was a play. I bought it. It was a little bit short dated, and I sold it at 169. The 69 10 calls. That's up 1,000% right now. 2 weeks later, right? But I had to cut it when I did because it was a little bit short dated. You know, because the problem is that when it's short dated, if you're right about the move, you can make good money. But if you're wrong, it's over. You can't even average down. It's over. So it wasn't that short, but it was like, oh, I'm up 35% on this in 2 days. I'm going to sell it. Now, what you do in that case oftentimes is instead of selling it, you could just roll that same option to a further dated leap or a further dated call. And it's more expensive because it's further dated out, but you've already up in profit. So you're really not, it's not like selling and having to rebuy or waiting for that. One of the things I had to learn a long time ago is if you sell, you know, you're like, I want to buy longer dated, but I'll wait for a pullback. You don't have to. You can roll an option. 5% out of the money, a fixed rule or adjusted for IV. Really depends. It depends if it's like going through an earnings or not. Because if you're just doing an earnings play, but fuck it, I'll take a monthly. Like right now, you know, if I was a gambling man, I'd look at NNE calls that, you know, like for example, not that I'm playing it, but based on what we just said about SPY potentially moving up, the sector's still strong, but we are seeing a lot of selling off in the momentum sector. But NNE's kind of holding it. You know, I would look, I'd be like, okay, I want to day. Let's say I want to day trade this, right? I wouldn't take anything more than a month, within a month. So I would look over here and I see October 24th, you know, $40 calls is $360 a piece, right? So it's like, oh, okay. So, you know, based on their movement, you know, IV is 88%. So you're going to overpay for it, but you're not really worried about IV crush because you're not holding it overnight. And you're like, it's $360, right? So it's like right here. So you'd say, okay, 360. And you look at the Greeks here. This is just me. IV is going to be messed up because the VIX is spiking and there's a lot of move right now. But I would look at this and I'd be like, okay, all right, so let me just run through this. All right, let's say I want to day trade this, right? So I'm looking at this. I'm saying, okay, we got one bid, 12 asks, but it's pretty decent spread considering this, right? You've got open interest of 254 and volume is 38. So it's pretty low volume right now overall. But that's because, you know, you're not seeing a bunch of movement on this specific contract. But if it does move, you know, that, or if that volume does start picking up, then you're going to see that there's going to be more people slapping that ask and bid quicker, and it's going to drive it up, right? Nobody wants to buy the implied volatility at 89%. But if you're day trading it, it's okay. So you say to yourself, delta's 51. So for every dollar that NNE goes up, you're going to make $52 on this contract, right? But if it goes down, you're going to lose 52. If it goes up $2, you add the gamma, so then it's going to be 4 plus 52, you're going to be $56. Now, this actually isn't a bad one to hold overnight. Okay, or over the weekend. If you're bullish on NNE and you're like, okay, I think it is, and I'll tell you why. While the implied volatility is pretty high, that's not going to come down. You don't have a crush factor because you don't have an earnings coming up. So it's not like it's building up for that. The IV is already high because there's so much volatility in the market right now. But look at that theta, right? That theta is only $7. So that means that you're only going to lose less than 2% of this contract if you hold it overnight just based on the decay. So if it stays exactly where it is, minus a little bit of IV, right? Because I don't know, the IV is going to come down throughout the day if the market kind of chills out. But that theta is only 7. So you're really not having to worry about decay on this. That's pretty good. Now watch the difference. If I take a 7-day $40 call, this, a little bit different. You were paying half the money, but 10 times the risk, right? Because you only think about the upside. You're paying about half the money. However, here's the thing. Your delta is only 45. Wait, what? Yeah. You're actually going to make less money, but because the contract is half as much, it's almost double the move. That sounds great, right? Sounds great if it goes the right way for you. If it doesn't, you're losing twice as much to the downside for every dollar it falls. Here's the other thing. Your theta is 10% of the contract. If you hold this over the weekend, 10% of the money is automatically gone. Not to mention if there's an IV letdown, because these are priced up pretty high. So you're thinking to yourself, well, yeah, but I could make more if I'm right with this one. True. But if you're wrong, you lose twice as much. And if you're like, fuck, that didn't work out, but I think it's going to do better over the weekend or something's going to happen, you hold, you've already lost 10% as well. It's just the danger associated with that. So I would rather pay the price of 2 of those for one and get all of that security, because everybody wants to pretend and think that they're going to be right about the move. But you've got to remember if you're wrong. And here's the problem. If this drops in value, not only are you going to lose, $1 down on this is going to lose about 25%, 30% of the contract automatically. Add another 10% of whatever's left over overnight, you're down 50%, right? You're just, I would rather pay a little more or pay more and give myself that, well, I can still make money decently if it goes up, but if I'm wrong, I don't get wiped out. Because if you buy 2 contracts at 175 and it goes down $1, you've now lost $100, 33% of your entire fucking money you've lost if it goes down $1. If you say the same amount of money for up there and it goes down $1, you've lost like 15%. You've lost half of it. Just think about that. I blacked out there. What's Vega and Rho? You really don't have to worry too much about Rho unless you're like buying millions and millions of dollars of contracts. So those are really not as important especially if you're day trading. Unless you're really like institutional size, you really don't have to worry about it too much. Vega really is tied to the volatility though. That's going to add to your contract depending on volatility. But otherwise, it's not something you got to worry about. This is great if you have like long dated or there's like a Trump talking or something like that. This will do it here. So basically, if implied volatility goes up 1%, you're gonna add 2 Vega to the delta there. Good call on the SPY bounce. Oh, I haven't looked at it. Holy shit. Oh, fuck. We going to jail, bitches. Let's go. Let's go. Shit. We did it. We did it. We did it. We nailed it. We nailed it. We fucking nailed it at the exact moment. That's beautiful. Even did the little curl before the run. Oh, damn. Up 100% after you said SPY calls. I didn't say SPY calls. I said if SPY is holding this 658, it looks like I think it's going to bounce back up. That's why I drew the line.